Okay, so we're talking about an IPO. And that when we talk about an IPO, what we are talking about So what happens with the IPO is we've got a private company. It is unlisted. So it's not on the ASX. And so what is happening in terms of the IPO process is that the private company says, we need money. We need finance for our operations. And so one way it can do this is that what we could do is that we could list on the Australian Securities Exchange, if we're talking about Australia. What it does is it then sells shares to investors. And that what happens is that the company will receive the money from investors. And then the investors so that the company will receive the money from investors. So this here is the inflow of finance. And that the investors, they will receive the shares. They will receive the equity, which will then make them owners. Part owners, really, because they are only owning a relatively small amount or large amount, depending on their allocation. This allocation, that's the allocation of shares, that allocation is based on the share price and also the size of the investment from investors. So that because it is an initial public offering, that this only happens once. Once the private company has done the IPO, that what happens is that the private company that's unlisted, what we can say is that post-IPO, that the private company is now a public company with the shareholders and it has received the equity. So if we're thinking about it further in terms of finance, that an IPO here, that this is let's put it over here. IPO is an external source of finance. Because we are bringing in a whole bunch of new owners that are going to be putting money into the company and that are not owners at this point in time until after the IPO. So hopefully this was helpful.